So we're just going to ignore that that says chapter 5 right there. I do not know why it says chapter 5. We are clearly on chapter 6. It even has it, our objectives, learning objective 6-9, 6-8-6, probably just a typo when they did the PowerPoint. So the next thing, last thing we're going to talk about is long-term contracts. Some things take a long time to build, like ships and airplanes and, you know, a skyscraper. Lots of things like that take a lot of time and they take a lot of money. So we can't necessarily use the when the revenue's earned, so like when the project's finished, because we're gradually finishing part of that project. So we use what's called percentage of completion, progress towards completion, sometimes like that. Okay. So they give us this example, and this one's going to go on for several slides, this same example. And I'm not going to read it to you because I don't want to just record a video of me reading. Okay. I'm just going to pull out the main things that we need here. We are constructing a building for $5 million, and they give us all of this other information. Okay. So we're going to get $5 million. We're going to perform part of the service between 27, 28, and 29. Looks like we're going to finish it in 2029, starting in 2027. Okay. So right here, let's just look at 2027. We are going to put $1.5 million into construction cost incurred during the year. Okay. We will debit an account called construction in progress for that 1.5 million. We will credit cash, materials, or whatever else, however we put the materials into it. That could be labor, that could be a lot of different things that go into that. Okay. And so up here, cumulative actual construction cost. This is zero because this is the first year. Okay. Notice right here at the end is zero because that's the last year. Okay. So nothing else, there wasn't anything in the prior period. So our estimated cost to complete at the end of the year. So we're estimating this is how much 2.25 million is going to cost us to finish it up. Okay. What we've already put in at 1.5 million, and then that gives us the total estimated and actual construction cost of 3,750,000. Okay. We billed 1.2 million and we collected 1 million. Okay. So they kind of got these rolled together. Let me draw the line there so you can see the journal entries. So we did that 1.5 million. We billed 1.2 million, and we credited this account called billings on construction contract. And then we debited cash and credited accounts receivable for the $1 million that we got. Okay. So at the end, they made the exact same entries for all of those. Notice that, you know, our profit changed through these. Okay. So our estimated cost to complete was 3,750,000, but cost went up, which usually is going to happen, especially over a 3-year period. Just the price of materials and inflation is going to go up. So they're looking at 4.1 million cost, and then they were charging 5 million for it. So that puts their profit to 900,000. Okay. So recognizing revenue upon completion. This means not recognizing any revenue until the very end, which is not very feasible at all. Okay. Because you've had people working on that building for those 3 years. It does not give us really good information. So you can see where this can be kind of an issue when it comes to revenue recognition. Okay. If we followed like the line in the sand, that would be the way we did it, but that still wouldn't be giving our users good information. Okay. So recording it as percentage of completion and recording some of the revenue along with this is a better alternative. Okay. So they had, as we recognize that, these are kind of all jumbled up together. There we go. Okay. For the first year, now they did not tell us. I don't think they told us the percentage. They didn't tell us those percentages on those. They just told us these. So I don't think they gave us enough information there. But you can see here, right here. So revenue recognition, they recognized 2 million in 27, the 1,125,000, and then 1,500,000, I'm sorry, 1,875,000. Those are a lot of zeros, okay, over time. And you can kind of see if you were looking at your income statement, this looks a lot better, okay? Looks a lot better, okay? Now you can kind of see those numbers that we just did in all of these T accounts, okay? And you can see how we had that 1.5 million, had a balance, added some more construction costs, had a balance, added some more construction costs. Our gross profit is the 900,000. That's the difference between the 5 million and the 4.1 million. Okay. So recognizing revenue over according to percentage of completion, we will look at the total estimated revenue multiplied times the percent completed to date minus any revenue recognized in prior periods. Okay. So now we got some percentages. Okay. Looks like we're using almost all of the same numbers here. And these are exact numbers we needed for to calculate all of this up here. They should have gave us that first. Okay. They didn't give us the percentages, so we really didn't know where those numbers are coming from. Okay. But they did record $2 million in 27. They took 1.5 million and divided it by the total cost to complete, 3,750,000, which means we're going to record 40% of the revenue. So 5 million multiplied times the 40% gives us the 2 million. Okay. Then 2028, we have our actual cost to date, 2.5 million, and divided by the total cost estimated to complete it of 4 million. So that means that we are going to record 62%, 62.5%. Okay. We're going to take the 5 million. They did this calculation, but we're going to multiply it times the 62.5%, gives us 3,125,000. But we can't record this amount, okay? Because we've already recorded 2 million of that up to that point. Oops. I don't know what's wrong with my stylus. Stylus is going crazy. There we go. I don't know what happened with that. All right. So, but we've already recorded the 2 million. So we're going to subtract the 2 million. That's where the 1,125,000 comes from. Okay. We'll do the same thing down here. We've got 500,000 in revenue. We've already recorded this much because we recorded 2 million plus that. So everything else will be recorded in that last period. Okay. All right. We are looking here at cumulative revenue. We just went through those calculations. Revenue recognized in prior periods. There was none, no prior periods, because this was the beginning. That's why that's 0. Okay. And here is more of the calculations that I just did up there. Okay. All right. The journal entry. Now we took our construction in progress. We used the percentages to figure those out as well, because we were using that to figure out the revenue. Okay. All right. So we had our gross profit of 500,000 in 27, gross profit 125 in 28, and then 275,000 in that last year. because the gross profit totaled 900,000. Those three numbers should total up to be the total 900,000. Okay. So here's what it looked like in each one of those periods. We had revenue minus the cost of construction gave us gross profit of 500,000. We recorded 1,125,000. Our cost of construction was 1 million, gave us 125,000. We recorded the rest of the revenue in the last period, and the last part of the cost of construction gave us 275. Okay. After a job's finished, the journal entry is recorded that'll remove from the contract from the balance sheet by debiting billings and crediting construction in progress for the entire value of the contract. Okay. So we're just making those two go away because it's over now. But we just use those accounts to keep up with it 27, 28, and 29. Okay. All right, we're not going to do that. I went through here and deleted some slides because there was a lot. And there was one problem that I just kind of thought was redundant, so I just took it out. So now we're going to look at long-term contract losses. Okay, losses are a reality when it comes to long-term contracts. Sometimes whenever it comes to your realization that there is going to be a loss, you need to go ahead and record a loss. Okay. Could be an overall loss, it could be a periodic loss. Okay. And they went through one problem that's almost identical to the previous one that we did. It had a profit. I wanted to do the one that had the loss. So I'm sorry, you can hear my pages turning here. All right. So right here, we are looking at it's almost the same, but almost the same. Everything was the same for 2027, but boom, here in 2028, we realize that we are not going to make a profit on this. Okay, we're still contractually obligated to perform the contract, but we're going to lose money on it now. Okay, and that other slide said when it comes apparent that you are going to lose overall, you need to go ahead and record all of the loss right then. You don't wait until the end, okay? You don't do it as a percentage or anything like that. You go ahead and you record it as a loss then, okay? So in 2027, it looked like they were going to have a profit. They recorded a gross profit of 500,000. That's from the previous example because that was the same, okay? Then they come down to 2028, cost went up, and now it doesn't look like we're going to make a profit. Okay. So we have to reverse that 500,000 because right here it looks like we're going to have a $100,000 loss. Okay. So we have to adjust that gross profit by 600,000 because we had recorded 500 here and then the 100 there to get it to the negative 100,000. So you can see the totals 100,000 right after that. Okay. 2029 comes along. We realize we're going to have another $100,000. We're going to go ahead and record that. And then that will get us to the $200,000 loss. Okay. So we're not using that percentage because as we go forward, because we know we're not going to make money. And it became apparent in 2028 that we were not going to make any money. Okay. I think some of the next few slides go through some of the journal entries and things like that. We've kind of went through some of that, so I don't want to make this video absolutely too long. All righty. That is the end of chapter 6. I will see you in chapter 7.